All right, welcome back to the Risk Reversal Podcast. We have a special guest today, Brian Hartigan. He is the global head of ETFs and index investments at Invesco. Brian, welcome to the pod.
Thanks for having me today.
So we met a few weeks ago on the set of Fast Money. You joined us. It was the 40th anniversary of the QQQ. We actually spoke about it, Guy, in the break. When it was launched, it was the QQQ. It was the quad Q. Isn't that what we used to call it on the trading desk a little bit? So this is one that has been near and dear to my heart. I've been trading this thing, I want to say since the late 90s, fairly actively, traded options on it, used it to hedge, speculate, a whole host of different things. So we want to get into the kind of the construction. We want to get into the concentration and the like. But the RSP, the equal weight S&P, has been something that has been near and dear to Guy's heart. Now, first things first, Brian, Guy is an alum of Georgetown. He is like Hoya #1. He had 3 kids that went there. My wife went to Georgetown. I have 2 girls there right now. And every time I'm on campus, I go to a football game, I go to a lacrosse game, I go to the Cap One Center to see the basketball team, and there is just Invesco all over the place. What's up with that? The CEO of Invesco, is he a Hoya or something?
Look, that's us, getting the word out and expanding the brand. So Georgetown, there's a number of affiliations in the Midwest, University of Illinois. I'm a longstanding suffering DePaul fan. Many defeats to Georgetown and the like. But the sponsorship, you'll see quite a bit of presence of the Qs coming into March Madness, which we have in a couple of weeks. And we're really excited about our presence there in market.
Believe it was the Ray Meyer era where DePaul was sort of the top of the shit pile, and obviously things have gone south since then. But let's talk about, getting the message out. There's a myriad of different ways, and I'm sure the investor base and the trading base, for that matter, has changed considerably, I would imagine, since COVID. So maybe you can speak to that.
Yeah, I mean, you teed it up. The Qs are the second largest and most liquid ETF, second most liquid and traded ETF within the market, and that's come over the 25 years of not only the presence, the building of the unique constituents within the fund, but also the performance, right? It's one of the best performing large cap ETFs that you can find in the market. So it delivers on that story and on the results for investors, but it's grown to well over 300 billion. We've taken different iterations of QQQ, and it's a 25-year-old structure. We've modernized the structure with QQQM, which allows reinvest and securities lending and takes advantage of new market structure. So performance is one, liquidity is one, and it's really one of the early poster children for ETFs as an efficient vehicle to market access, right?
Yeah, so we get questions all the time from retail, obviously on Fast Money, but through our podcast about what are some of the vehicles that we use to invest, but also trade. And this one's really interesting to me because of the building concentration, let's say, over the last 10 years. If you look at the top 10 names, they make up 50% or so of the weight of this index. Now, what I find interesting about the construction is like everybody wants to be exposed to those top 10 names. There's a reason why they've gained so much in market cap. They are the best, performing companies, which is reflected hopefully in the stock market. But then you also get the other 90, which there's probably some great themes that the top 10 are being rewarded for that maybe the other 90 are going to get in the future at some point. So talk to us a little bit about the construction, because to me, I always say to investors who are looking to get exposure, across the major themes, but also, tech, that this is a great way to play it. You don't have the idiosyncratic risk of going all in an Apple or Nvidia or something like that, but then you get a lot of exposure outside those top 10. So talk to us a little bit about the construction and the concentration.
Yeah, so at its surface, some might say, look, this is an index fund and you're buying what's in the index, but the unique aspect of it is that the index started off the NASDAQ exchange, right? And what does the NASDAQ exchange and companies that list there represent? Innovation, technology, and advancement of the greater economy. And those are the companies that tend to seek to list on the NASDAQ. Palantir is a great example that made the change into NASDAQ and migrated into the NASDAQ 100. So it is market cap weighted. So with a ceiling on limiting some of that concentration, and we've implemented some of those parameters by rebalancing the index when that concentration starts to hit too high. So there's a control factor to the index and the methodology within the fund. But to your point, you're going to get higher exposure to the top names. but you want those next names graduating up into the top 10, 15, and 20. So as opposed to just holding and concentrating a 3, 4, 8 stock position, you're getting that graduation naturally as the market evolves within the index.
When you think about an index like the NASDAQ 100, let's talk a little bit about the evolution of the evolution of the product of the QQQ and some of the use cases, like how you've seen that evolve over the years. Because I think when it was introduced, or at least when I started trading it, a lot of folks were trading the futures, and again on the CME and the like. And this product, once it started getting a level of liquidity, I think that it became like an active trader's sort of tool. But then it also evolved, and I remember in the 2000s is like if you had a portfolio that was heavily weighted towards tech, this became a great hedging tool also. So I'm just curious if you can give us a sense of like how the use cases of the product has evolved over the last, let's call it 30 years.
Yeah, and I can use this for Qs, RSP, and some of the others, that it becomes part of the liquidity ecosystem, right? So why would you want access to an index or an index future? It's either immediate, it's equitization, it's quick exposure, and it's super efficient in terms of its cost and its liquidity. Potentially over time, there's basis risk, there's tracking error from the contract itself to the fund. And as Qs grew larger and larger, as it grew from a liquidity basis being tighter and tighter, it serves as a competitor to the futures market. So we tend to see quite a bit of trading within it, but assets have been terribly sticky, wonderfully sticky, I should say. And we do have quite a bit of long-term holders within the fund. And I think it's moved from that trader's vehicle to, wow, this is a large cap, innovative access to some of the world's greatest companies. And people are seeing through the liquidity aspects and buying it for a true hold of the underlying.
Yeah, and we just mentioned, when you buy an ETF like this, you get that broad-based exposure, obviously heavily weighted towards those top 10. But you also have a situation which I find interesting. So you don't have the idiosyncratic risk of one of those names, but you also, from a vol standpoint, the vol is kind of dampened by the fact that you have 100 stocks in there, right? So when I think about expressing directional views, I can look at the QQQ, but I can also trade options on it, right? And because the vol is, like I just said, generally lower than any of those components. Give us a sense of options traded in and around it. I know you have some products that kind of incorporate that, because that's something that a lot of our listeners might not be aware of, how you've kind of merged these two products.
Yeah, and if I can maybe placate both of you in terms of agreement of QQQ and RSP being those two sides of the market, actually, when you combine them, your point on mitigating risk and dampening downside, you see a negative correlation in terms of the excess return. Quite simply, they behave differently, right? So putting them together, you're able to capture those upside moves from concentration, and you can defend when that moves away from you because of the RSP dampening effect. So together, quite an effective market access tool. But within that, right, for each investor that's either looking to dial up concentration or mitigate some of that concentration through equal weight, we did implement option income strategies. So what we call our income advantage. So RSPA, QQQA, you get exposure to the underlying index, and then we'll write calls and create some downside protection within that. So you get a lower beta profile. You're generating income from the index, which otherwise you're not getting for those particular investors. And then that serves as a bit of a downside protection for you through the income.
You know what's interesting about that? And so it's a lot easier to buy that product than actually have to do the overwriting, because I get the options market and I really love using options, but the idea of continually doing those overwrites to get that atom income, and it's also like, what are you going to do? Collar the QQQ? You can actually use your product to get that downside protection while also creating a little income.
That's absolutely right. You've seen actually option utilization increase due to the spike of some of these products. So buffered or hedged, those types of in name utilizing options, and the options market has benefited from it. But like anything with product proliferation creates confusion, right? Which month do I pick? How much downside do I want? Do I want to give up all the upside? So this effectively takes it down the middle in terms of an active approach. will give you the balance of what's best within the market. And because of the liquidity increase, we actually roll these daily so that you don't have the path dependency, which might come from a third Friday type strike where you've got a lot of volume moving into the close. So it creates a smoother ride than picking one single strike and managing month to month.
In terms of the construction, and I'm fascinated by this, I don't know this. My guess is like ARM Holdings was maybe one of the most recent IPOs that was added. Palantir's obviously on that list. I guess my question to you is, how does it work when, a company goes public? Do you have a team of people that make the decision, we're going to include this company? And to that extent, once there's an inclusion of for example, Palantir, does that mean by definition the exclusion of another company in the space or in that sector?
So important to know, it's 100% rules-based. We have passive equals index, and then you have active, much more discretion. And then we play it down the middle where, as I mentioned, QQA and RSP, combination of both, right? The embedded equity exposure is passive, but then your option writing has an active bent to it. So for any index or the NASDAQ, it'll have a rule set where when they do, if they hit minimum market cap, minimum trading, and they're within the universe of the index then gets struck either annually or quarterly reweighted. And then our approach is to ensure we have the liquidity and we can track the paper index via the live, real life market impact approach to investing in the ETF. So again, while many say, "Hey, aren't you just buying the index?" As you know, markets are incredibly living, breathing, and volatile environments that you have to navigate through, and nothing's guaranteed. So we've done a great job in terms of tracking error, which is ultimately what we compare ourselves to in terms of how well did we deliver on the return. So
great explanation, because I think a lot of folks who kind of trade these things or invest in them, they probably don't have a clear sense for how that process works. A lot of times you'll get that headline, such and such added to the NASDAQ 100, this one out, and you're thinking, is that a discretionary sort of view? But the rules-based makes a lot of sense. Let's spend some time on the RSP. This is the equal weight S&P, and this is a great day to kind of really speak to this. So we are Thursday into the close. The S&P is down about 2% on the day. The NASDAQ 100 is down 3% on the day. The RSP, the equal weight, is down 1.4%. About unchanged on the year, believe it or not. It's down 40 basis points, while the S&P 500 is down about 3%, and the NASDAQ 100 is down nearly 5%. So in periods of downward volatility, how do you see interest in the RSP? Because again, if you think about it, we have many of those top 10 holdings in the QQQ are down double-digit percentage. Now, they've massively outperformed over the last 2.5 years. So does retail have the same interest in these products, let's say, as institutions? And why might they? Because we quote the RSP all the time. I think on one of our podcasts today, we're talking about it because it really helps make certain cases about the names that are driving performance in the market.
Yeah, I think it tends to start a bit more retail driven, although we have institutional fundings on new launches that are very institutional minded. So it depends on kind of the launch, but then the evolution grows through trading activity, adoption through wealth, and ultimately, as it becomes more liquid, like RSP has, it takes on a larger institutional profile. And we've seen investors, U.S., international, take fairly large allocations into RSP. And it is simply, as you stated, while we do have that market concentration, which RSP is the inverse of, right? Equal weight is very simply not market cap weighted. Traditionally, it had been a bit more of a play on the size factor. So when we talk factors, right, you get less large cap because you're not market cap weighted, and you benefit from small and mid cap markets. But because of the concentration and how large some of the largest names have gotten, you've seen RSP become kind of that mitigator to the concentration risk. So what's appealing to investors, they want to know what they're using, what's in it, and how it's going to behave. And of course, no guarantees on anything, but you're going to have a much lower weight to the top 10 stocks driving the market simply by the name, right? Equal weight, 500 stocks, 20 basis points, if my math is right. So that gets you to broad diversification, fairly large underweights, right? And while it is a passive fund, when you look at your active exposure to the market, RSP is very active compared to its weightings, right? To the QQQ as well as the S&P 500. So very different.
Their asset class is seemingly rising up. I mean, Bitcoin's probably the last one that's gotten to the level. I think it's approximately $1.7 trillion. I don't know exactly, but I think I'm pretty close. With that said, what's the determination around asset classes, and then how they subsequently could get basically part of the Invesco family, if that makes sense?
Sure. So in terms of how do we evaluate product or launches to the market? Great question. So, we're within the original launch of the Bitcoin suite of families. So BTCO is our ETF. That was an opportunity that, one, we have an alternative product line. So DBA and DBC that you mentioned before, we view Bitcoin as an extension of the alternative suite. We have an extremely large factor suite, and we've built on our QQQ suite. So as I mentioned, QQQA is the option income, right? How do you build out some of the investor preference, and can you engage and articulate an opportunity in multiple different ways? So long Qs, QQA with option income. We have QBig, which is a overly more concentrated version of the Qs. And we have XLG, which is the concentrated S&P 500. So it's part of your approach and the engagement, and I call it the feedback loop from your clientele in terms of how are they trying to broaden out some of their solutions. And for us, we're a global provider, have multiple different capabilities across passive, factors, alternatives, and active. So we try to make sure that those launches are effective, we're capturing market demand, and that we can ultimately compete and deliver on the investment objectives.
Well, Brian, as a team, Guy and I were particularly bearish heading into 2022. So we got that one right. And, when you think about some of the biggest names in the index, for instance, it was Tesla, it was NVIDIA, Meta, and Netflix. They lost like 70% of their value from the peak in 21 to their lows in 22. But what was interesting about that, and again, we were in the mindset that presented opportunity when the market finally bottomed, and we would go on CNBC, and Melissa Lee, our host of Fast Money, would say, all right, we know you guys are bearish, but okay. And then we'd also have people, retail investors or listeners of our podcast or friends say, hey, listen, this doesn't feel particularly good, but how do I get exposure? You know what I mean? I'm never going to be able to pick the bottom. And we used to say, like clockwork, just average the Qs, because there was this mindset that, some strategists are like, okay, well, if the heaviest weighted tech stocks were the ones that led in the bull market, they're not likely to lead out. And we were like, that's impossible given the construction of the market and where the innovation was, right? So our whole test was like, let's just dollar cost average, whatever your time frame is. Is it weekly? Is it monthly? Is it quarterly? Because that's the way, when you look back, that's going to be the outperformance in the next bull market, right? And so I'm just curious, because a lot of folks said, okay, you guys were bearish. Maybe you stayed a little too bearish for too long, but that was good advice because their averages were much lower. So how do you see folks kind of using these instruments to kind of execute long-term views? We trade them, you know what I'm saying? But a lot of people are probably using it as a much cheaper way to get access to these markets than, let's say, mutual funds or other funds that are underperforming that you pay much higher fees than something like your ETFs.
Yeah, there's a tactical approach, as you said. Are we getting a little cheaper? Is this an entry point? The market hates uncertainty, but it's never going to get any level of certainty. And you see these last few days trying to dissect, what is day to day, if not hour to hour news that is going to impact the long term economy, right? So how do you position for that? Certainly, we see these blips, and you guys talk about it every single day, right? So being long and long-term has been effective within the equities market. So how do you use these corrections as an opportunity either to do what you were thinking of doing, if that was, reducing your concentration, right? If you're looking to make a call in the market that you think this is going to persist, that might be a factor rotation. So this year, if you look at short-term, low volatility has been an area of performance, right? It's outperformed momentum, which was a big leader last year. So we do see tactical rotations and some of these these market corrections as that catalyst to say, all right, well, now's a good 3-month, 6-month, or 12-month window to tactically allocate. The ETF market has grown substantially within fixed income as well. So while we don't see massive flows moving into a risk off and all fixed income environment, there are folks making duration bets within the fixed income lineup that's grown, and you have all those utilities to make that call. Right now being another difficult call, right? And do you want to be long duration and get a little bit of income, or do you want to play it down the middle in the intermediate space? So all of it being kind of valuation driven and catalyst about what my future outlook looks like.
Brian Hartigan is the global head of ETFs at Invesco. We appreciate your time. This was a fascinating conversation, and I'm sure we're going to have you back soon. Thanks, Brian.
That's good. Thanks, guys.